Good afternoon, everyone, and thank you so much for allowing me to speak at today's presentation, for inviting me. Today, I will be talking about trading psychology. I'm not a trading psychology expert, but I can share from my personal experience what has helped me and what has helped my trading to improve on the psychological level. So I have a lot of points in here today, and feel free to ask some questions. Feel free to pick my brains. And this is basically a presentation that is from the lens of a 20+ year trader. So for those of you that do not know me, my name is Anka Metcalf, and I'm the CEO and founder of TradeOutLoud.com, which is a trading education company that is designed to help traders, educate traders into their trading education journey, taking them from student to pro trader. We also have services that are helping the traders fast track, filling that gap from the experience point of view, from the education side to the execution side. I have been a professional trader focused on futures and equities for more than 20 years, actually. 10+ years in investment banking prior to becoming a professional independent trader. I specialize in high velocity trades. So what that means is that I look for areas of tradable voids on the technical patterns, multi-time frame with a multi-time frame alignment in mind, where price can escape with ease into the next targets. And I'm also the designer of an institutional proprietary trading system. The reason why I'm the designer is because I put a spin into elements that were already in front of us. And this you can do on your own based on your experience as well. So because I have been trading for so long, I have noticed some things that are happening in the market at certain times, at certain locations. So that's why I put my spin on technical analysis that has been around. I can't take credit for technical analysis or for reinventing the wheel, but I perfected a system that allowed me to get to where I am today. I'm going to show you some stats from my portfolio, and even tomorrow I'm going to show you in depth how I managed to literally double my portfolio in the first 4 months of trading. And I'm going to show you all the trades that I have executed. And tomorrow we're going to do a presentation. And for that, you need to take notes, because that is going to be a lesson. That is going to be a workshop, not so much, kind of like the presentation where, you're going to have a sales pitch. But anyways, so for those of you that don't know, price support resistance is very important on the technical side, right? So price support resistance is everything to price action, because these are reactionary areas. But in fact, there are 8 or 9 layers of price support resistance based upon which price action reacts. So you have to pay attention to all of them. Specific trigger times, like I said, because I have been trading for over 20 years in the market, I have developed trigger times for the market. And this is coming from my background of stock trading, because when I started day trading, when I dove into day trading, I dove, like I said, pretty much really well educated into trading. So first I got my trading education. I practiced a little bit, and then I opened an account, I funded my account, and then I started trading. So these specific trigger times are coming from my own personal experience. These are trigger times that you will see that they work every single day in the market, regardless of how choppy or crappy the market is on any given day. I also focused on specific price zones. These are specific price zones that institutional traders use to leg in or leg out of trades, because as you know, they don't really have the capacity to purchase, for example, the Qs at a certain price, or NASDAQ at a certain price, NASDAQ futures, or Apple at a certain price, or whatever they're trading, or futures and what so. So what they do is they leg in and they leg out of trades. And these are 4 price points on the technical charts where you will see this kind of activity. And if this collides with the specific trigger times that are not very many for the New York trading session, there are only 3. So we do have trigger times for the afternoon session. We also have trigger times for the London session. The only session that does not have trigger times is actually the Asian session, and the Asian session is also lagging. It is also lagging algorithmic trading because it's very, very thin. I also focused on chart synchronicity and divergency. This is a concept that that was not, I cannot take credit for it again. It was there from the get-go, analyzing the market through the prism of relative strength and relative weakness has always been around, and divergency has always been around. So when I look at the market, I look under the hood, I look at the basic indices, I look at the Qs, the SPY, the diamonds, Russell, and then I look at the futures indices. Of course, I start the day with the futures indices because I want to have an idea of what had happened in the overnight trading session to have a really, kind of like in-depth vision of what the next levels may be for the New York trading session open, because I do specialize in trading only the first 2 hours in the day trade only the first 2 hours of the day. Just because you're a day trader, people think that, oh, you're a day trader, you're stuck at the computer all day. No, you're actually, I have created a system based on which I take advantage of the most volatile time into the market, which is also the professional time into the market, where I designed a system to find trades with fees at the precise locations, using my specific trigger times, using these specific price zones that are going to help you find trades with ease. All right, so let's get started. If you guys want to get a hold of us, you can find us online. It is TradeOutLoud.com, or you can visit any of the social media outlets, and our handle it is TradeOutLoud. So here are 5 signs. We're gonna dive right into it. Here are 5 signs that show you whether you're a gambler or a trader. Do you guys want to know what these are? Well, number 1, your risk is not in sync with your account size or your risk tolerance, which creates massive capital fluctuations in your account. So what I'm trying to say here is that a lot of time traders are using more risk than they should use. Risk is something that we should apply on any single activity, trading activity that we do. And also it has to be in sync with the account size that we have. It's not that on one trade, we're going to risk $500 and on the second trade, we're going to risk $1,500 just because we like that. You have to keep your risk consistent. So what that means is that you're going to determine, and we're going to go in depth into tomorrow. I promise you guys, this is again super serious. I want you guys to take notes. Tomorrow we're going to talk about position sizing 101 and what risk can do to you, and also how you can benefit from this simple strategy, because it's not about the strategy that you trade. I'm pretty sure that right now, if I would talk to you guys, you would have a strategy, right? Because you have been either you either got into trading, whether a long time ago or recently. Do you kind of have an idea of how the market works? Do you have an idea of right price support, resistance? Like, you have an idea how to, I have met some pretty outstanding traders in my 20 plus years of trading activity where they didn't really have a lot of trading education, but they had a system that worked for them. But there is this one constant that they have applied, and that is the risk, the same risk on every single trade. But you're going to see tomorrow that there's a catch to this, because you need to apply the same risk on every single trade. However, you need to calculate the position sizing for it. So it's not just like you're entering a trade and you're watching your P&L. And for example, if your risk per trade is 500, once you see the price action go to 480 or something like that, you're going to kill the trade. No, you have to make sure that you allocate the right position sizing for the trade. Now, too much risk applied per trade triggers the risk of losing all capital. I have seen traders, and this is the sad part of the trading, and especially it happens into the futures market and it happens into the Forex market a lot. The problem here is that you can open an account with so much ease. You basically need about $5,000 to open an account at a reputable brokerage, or there are some brokers that just want your money and say, hey, open it with us with $100 or $500. Now, what are you going to do with $100 or $500? If you want to test your strategies, you could do it really well in a simulated account, or you could do it with a prop firm. Don't risk your money. I mean, when it comes to, brokerages and all that stuff, do your due diligence. The other thing is that not having a trading plan. A trading plan is so essential because a trading plan puts your mind at ease, because it's as simple as you see a setup, you take the trade. You don't see the setup that you have designed in your trading plan, that you have mentioned in your trading plan, that you wrote it down with specifics, then you don't have a trade. If you have to squint at a chart, then you don't have a trade. It means that the trade is not there. Don't try to force trades. And again, having a trading plan is as easy as having a little post-it note in front of your computer. You don't have to write novels. You just have to determine the time where you're available to trade, time devoted to the market, write down your risk per trade, which is essential, and write down the strategy that you're going to be using. For example, if you're, let's say, a day trader, if you're trading stocks, if you're a stock day trader, if you're looking if you're looking at a stock like Apple, for example, and you say, hey, you know what, I'm going to look for Apple to pull back into 20 SMA. We're going to look for a technical rotation, being in an uptrend or what have you. I'm going to take it long, off of the 20 SMA or into support or something like that. So something very easy. And you don't have to start with 5 strategies. Remember that most of the time in the market, I only use 2 strategies. I teach 10 strategies in my courses just because, there are 10 strategies that you can actually really highly sought after strategies where you can make a lot of money on. But basically, when it comes to trading on a day-by-day level, the more frequent setups that are happening in the market are just 2. Do you guys want to know what those 2 are? It's either the buy setup or the sell setup within trends. And it's the breakout or the breakdown, obviously into trends. So these are the 2 most important strategies to the bull side and to the bearish side that can be applied with really high success, And then the other thing that you need to have in your trading plan is basically lay out your trailing method. And remember, trailing is also relative because it's not the same on each and every single trade. For example, if you have a trade that is screaming higher, your trailing is going to be different. If you have already achieved targets, or if you have a trade that is barely moving, your trailing system is going to differ a little bit. But having a trading plan should be easy and should be on that little post-it. And when you come in front of the computer every morning or whenever your trading time, whenever you have allocated time for your trading, you just look at the little post-it as a little reminder, read it out loud. And then, because when you read everything out loud, it just makes more sense and it gives you that confirmation. The other thing is number 4, entry. Entry trades chaotically. So there's a little typo in here. So entry trades chaotically based on impulse, not knowing what the real market trigger is. Market trigger is real. There are areas in price action where you're going to see that if the price goes into that specific price, it will trigger and it will start moving for you, whether up or down. So triggers are real. A lot of time traders feel that, you know what, the risk is too high for this trade. I think that I'm not going to wait for the trigger. And then they just jump into the trade. And that is called impulsive trading. And when you do not respect a setup, the market smacks you because that's what it does, right? So learn to obey the market and literally listen and tune in to the market rules. And then, of course, what happens after you have a losing trade? A lot of traders find themselves revenge trading or simply over trading. And I agree, if the setup is there after you have stopped out once or twice or 3 times, by all means, respect your trading plan and go back in the market as long as you have the allocated R's for that specific day. So using an R system that we're going to be talking about tomorrow is essential in this sense, because that system will allow you to take a certain numbers of trades per day. And if you use all your strikes, then you're out. So you For example, for day trading, I use 5 hours on an average every single day. But for example, if I have a day like today, where we have FOMC pending in about an hour, less than an hour, I'm not going to take any trades ahead of FOMC. There used to be a time many years ago, maybe 15-20 years ago, when I would get into the market, but I've learned better since then. So it's truly not worth it. And over trading is a real thing. Traders think that sometimes when you have losing trades, for example, you allocate your risk amount, let's say you have a $500 risk per trade, you basically use that $500, you stop out. They think that if they double up and use $1,000 after you have stopped out from that $500 stop loss, you're going to be able to recuperate the loss much easier, which is wrong. And I'm going to show you how to do it the right way tomorrow. But let's continue our psychology journey. But there is a way to make money. And here I'm going to share with you the 10 ingredients that are going to impact your trading and increase your profits. Number 1, developing a winning mindset and creating a routine. This is very important because trading is not gambling. Like I said, we talked about the difference between gambling and, being a gambling trader and being, a true trader. And you don't want to be gambling, because when you're trading, you have to be very well calculated. You don't have to be a math whiz. There are plenty of tools available that allow you to use without being a math whiz, because people think, and people are often intimidated saying that, oh my gosh, I have to have a PhD in mathematics in order to be a really good trader. Wrong. You don't have to be a mathematical whiz, right? You just have to be open-minded, educated. Technical analysis is a must. Learn everything that there is about risk management, and of course strategies, and that is what makes a rounded trader. Now, success of the trade can only be considered if you take into consideration risk. Tomorrow we're going to go in depth into here. So this is exactly what I was mentioning at the gambling side. A lot of times people are just like getting into the market, they throw a couple of $100, they throw the dice, and they roll with it. Whatever happens, without having that conviction and without having that market knowledge that will allow them to actually profit from that move. Because you see, in the market, you need to love money, because we're all here to make money. We're all here because we want to quit our 9-to-5 job, just like I did many years ago. You want to be financially secure. You want to be financially independent, right? And you want to learn how it's done. I was very fortunate that I met some individuals that have helped me fill that gap from the student side all the way to the pro side. So I want to be that person for you that can fill this gap for you. So basically, when we talk about risk, this is the first thing that should be taught when you're starting to trade, and it should be in your first class. It should be like the first thing that you learn about trading, how to manage risk and how to manage your way around a bad trade, and how to manage risk in a good trade. So I'm going to show you that chart a little bit later. So trading or gambling, trading is a business, right? So trading is a business like every other business, and it's not gambling. Like, think about this. There are some brilliant minds on Wall Street that are traders, right? We are talking about Goldman Sachs, that we're talking about JP Morgan, these individuals and so many others. And there are individuals that are managing huge hundreds of thousands, billions of dollars in portfolios. Okay, so it's a very serious business. So they've learned how to do it. Now, think about this. When you talk about a doctor, right? Doctor goes to school. He goes probably for 4 to 5 years. Then he does his residency, another 3 years. Then he, needs to practice for another 3 to 5 years. So it takes more than 13 years in order to become a successful physician, right? Lawyers the same way. They go to college, right? They go to university, they have to pass the bar exam. And that takes probably, I don't know, maybe 8 to 10 years as well. But no, when you're starting trading, you think that if you watch CNBC and if you have $500, you can open an account and boom, that's just gambling. Trading is about following rules, strategies, and planning. And it's about how well you follow these rules, because you need to be extremely rigorous when it comes to the trading rules. I, for example, have many trading rules. I don't trade FOMC days. I don't trade option expiration days. That's just me. It doesn't mean that you should not do this, but over time I have realized that my performance does not do really well on these days. And I have an elevated risk of stopping out of trades because the price action is not true to value, it's not true to price, it's not true to technical. So therefore, why should I risk my money? I love my money too much in order to risk it. And then it's about following the strategy. I was mentioning before about waiting for the trigger point, the trigger price, right? The trigger price is very important because it shows you the possibility of the price continuing higher or lower. That is the confirmation. It's so called the confirmation. So the trigger is the confirmation whether you should be in or out of the trade or simply sit on your hands. Don't get the, for example, if you have a range, right? Imagine a range. So you have that choppy range back and forth, and there is a setup that is forming in the middle of that range. What do you think the outcome is going to be? 50-50, right? Because it's not breaking above the range, it's not breaking below the range. So there, when you see ranges and when the price is trading in between, you don't have any confirmation from the price that it's going to go higher or lower, even if it's, for example, if this range is happening, for example, in an uptrend, right? So if it happens in an uptrend, what do you think is going to happen? Okay, so let me just take this. All right, so now you have an uptrend and then you have a range happening, right? You have this range. And all of a sudden, okay, you're seeing a setup within the range. You go like, okay, this is it. I'm going to go in. This is a rotation. I'm going to take this long. Like, what do you know about ranges? Do you guys know about ranges? So an object in motion tends to stay in motion. So for that reason, where you think this price can potentially go easier to the upside. So the velocity is to the upside because an object in motion tends to stay in motion, right? So when you're having a setup that is forming in the middle of the range, you're exposed to 50-50 risk. So there's a 50% chance that you're going to make money, but there's 50% chance that you're going to lose money. The best outcome for this trade is to take it at the breakout, or obviously to place the stop below the low, right? Or if it just expands higher and you miss the move, wait for the pullback to happen, and then you're going to have a much lesser risk if it's doing a minor support buy though. Okay, so that's the thing about waiting for the proper setup. Okay, waiting for the proper trade. Trading is all about discipline and professionalism. So for example, treat trading as a business. You're not going to see me coming in front of the computer in the morning in my pajamas sipping coffee. No, for me, it's a regular trading day. I get up, I get dressed, I have breakfast, and I go to work. So when I show up, I'm not going to show up in my pajamas, right? Because I respect myself, I respect the market, and I respect my environment. So I'm a professional when it comes to coming to work into the market. And then when the market opens, I'm not going to take a break 10 minutes in saying, oh, you know what, I'm going to go grab a cup of coffee. I'm going to go get the mail. No, it's my dedicated time. It's my Zen time. So that your Zen time you should use to find setups. By the way, guys, when I come in the market every single day, do you guys think that I'm getting up every morning and when the market opens, I go like, oh yeah, I want to make, let's say, $5,000 today. Do you think that's the case? No, I don't look for that. When I wake up every morning, I say, I want to find the best possible setup that I can find, a really reliable setup that I can find. This is my job. My job is not to make money. My job is to find the best possible setup. And once you shift your mentality from money to setup, Money's just gonna flow because you're not gonna be focusing on creating the money, of pulling money out of the market, but you're gonna shift it's a quick shift mindset to literally finding the best setups that there are in the market. And if there aren't any setups, just don't trade. You're not forced to take a trade. Just because you're a day trader, you don't have to take a trade that day. Even if you're a swing trader, you don't have to take a trade that day. Trading is about hitting home runs. It is not about hitting home runs on each trade. And especially in this kind of choppy environment, I'm talking about the majority of the futures indices, the major ETFs, the Qs, the SPYs, etc. And even in stocks, you're going to see that the majority of them are in huge ranges. Even one that is particularly strong that I'm looking at it right now is Procter & Gamble. Oh my God, so strong. Even in Johnson & Johnson, for example, they're so strong, but they're in a range. So you have to wait until they show clues of snapping above the range or snapping below the range. And by the way, hitting home runs on each trade is impossible. And so unrealistic. But for example, if you're looking for the best possible setup for the trade to get in, always make sure that you measure. And we're going to talk in depth about this. And I have examples of plenty of chart examples. I kept the creme de la creme for last. So basically, when you look at a trade, you have to identify what? You want to identify the entry. You want to identify, for example, this is the technical rotation. So basically the price is coming in and then it's rotating, right? So you want to find out where the stop is. You want to find out where the entry may be, right? In this case, this may be an entry as part of the rotation. This is the buy setup. And you're going to be looking, for example, here, if this is the pivot, you're going to be looking for a T1, which is over here. This is target 1, right? So this, sometimes you're not going to hit a home run where the price action is going to hit this T1 because you need to have velocity in the trade. And right now we're lacking that velocity. If after FOMC, and I don't think that the big move is going to happen with the FOMC. Everybody's expecting what it's expecting into the FOMC with the basis points and all that. We have, it has been in the news a lot. I'm not going to bore you with that, but I'm going to tell you what is more important today. Today, the FOMC press conference is going to be more important than anything else because traders and investors are going to be looking for clues whether they're going to further hike rates or not, or what their game plan is. They're interested in their game plan. And guess what's going to happen? If their game plan is, let's say, to slow down or kind of like keep them unchanged or something along those lines, if they see like some kind of normalcy happening, guess what's going to happen to the market? The market is going to go ballistically higher today. If, however, the impact is going to be negative, meaning, yeah, we're going to be raising 50 basis points into the end of the year or 75 basis points into the end of the year, the market is likely to remain sideways within the same context or even pull back even further because it's going to take the assumed risk. So in that kind of case, you may not achieve this T1 over here and the trade may stop along here. This is not a home run. This is a home run. This is not a home run. So from this point on, you can get the trigger. It can run a little bit higher. And then, for example, it starts rotating down. When you see the price action starting to have, kind of like problems continue with its continuation, then it's the time to lock your stop and break even. Okay, break even. Your entry becomes your stop. And this is going to protect your account. More on this tomorrow. I promise you it's going to be a really amazing day tomorrow. And trading is about being honest with yourself. I see a lot of traders that are beginning, and they're testing their strategy in a simulated trading environment, and they're not realistic. When you're trading a sim account, you have to make sure that you keep it as realistic as possible. I see a lot of times traders hitting 10 contracts, 20 contracts, or doing options, again, with same number of contracts, day trading futures with same number of contracts. And again, in futures, we're going to talk about this again tomorrow, but in futures, there's this misconception thing that if I have, for example, a certain account size, I could, some authority The futures trading god will allow you to use the same risk on every single trade, which is completely baloney. It's not true. You want to be a successful trader, you position size. Otherwise, you're going to blow up your account. It's as easy as that. I tell my traders every day this. Creating a routine is easier than you think. You have to develop a daily routine for yourself as a trader and for you as a market participant. So the daily routine should be with like, you get up at the same time every single day. You have your whatever you do in the morning. And then from the moment you come in front of the computer, you have to have this routine. What do you do first? You turn on your computer, you check for updates on your trading platform, you check your economic releases, you check the market context. So make sure that you have plenty of time before the market opens. It's not that, oh my gosh, the market is going to open in 10 minutes. Boom, I got to fire up my computer and I'm ready for trading. No, you have to have at least 45 minutes to an hour before the market opens to cover everything. You have to make sure that you look what happened in the overnight market, make analysis again, because a lot of times, and especially now in earnings season, you have stocks that are gapping up, stocks that are gapping down based on earnings, and you need to analyze them because they're different than when they closed in the prior day environment, in the prior day close. So the other thing is to determine your trading times and create your own schedule. So maybe you have a full-time job and you're, coming back home from work, and you go like, you know what, I want to see if there's an opportunity for a swing trade, for example, or for an overnight trade, let's say in the futures market, right? That is really optimum. And there are, conditions for that type of activity almost nonstop, especially with commodities at times. For example, gold, right? We had a killing in gold, and we're going to show you the stats of my trading gold tomorrow. But gold again triggered yesterday, and we're up like 15 points already in the trade. So even though we didn't take a trade right now today, I called the trade yesterday. We took a trade yesterday in the trading room. We're in gold, right? Do not trade without having a trading plan. We talked about that because that is a blueprint. Blueprint is very important for all your trading. So for example, would an architect or would a builder be able to build a house without a blueprint? Well, not likely, probably a teepee or something, but you need a really good plan in order to develop a really good, solid building. Enforce discipline. So if you don't see, again, enforcing discipline is knowing when to trade and not to trade, right? Simple, dates like FOMC and option expiration make, some really good times when you can stay away from the markets. And I'm not saying that stay away and step away from the market, especially if you're in the development part of trading. No, just make sure that you stay away from the market by watching it. I mean, don't take trades, because when you trade, you're going to put yourself into pressure. You're going to have emotions. Obviously, you are not going to be able to eliminate emotions. Everybody's telling you, oh, you got to eliminate emotions from trading. Yes, you are going to eliminate emotions from trading, but a little bit of emotion is good, and it's still going to be there because that's your hunch. And that is your, let's say, 6th, 7th sense of what you feel about the market. So that's very important as well. So having the patience to wait for the optimum time to take the trade, that is imperative. Wait for that setup to form. We talked about buy setup, sell setup. These are some of the most common strategies that you're going to be using in the market. I use them probably 90% of the time. And 10% of the time, I use the rest of the trading strategies, which are more refined. You can add on to them, but definitely have the patience to wait for that trade to set up. So for example, if you see the price that is going up, just don't jump in. Feel the urge, because where you're jumping in, people might start, or institutions may start selling it. And again, no plans, no to very little emotions. I'm always an advocate for stress-free trading. This is something that I do every single day for my own accounts. And also I teach my traders, and we trade together in the trading room with stress-free, like literally stress-free. Once you know that your risk is going to be 1R, right? Your risk is going to be 1R unit. So we're gonna talk tomorrow about this, but it's basically that standard amount size, right? So for example, you risk 1 or 2%, right, of your account, that represents your R. Okay, so if you have a $100,000 account, your risk per trade is $1,000. That represents 1%. And that is your risk per trade. And within that, you need to see how many shares, how many contracts you can fit within that based upon the parameters that the charts are giving you. Because you're not going to have two setups that are the same. You're going to have a stop, which is, for example, $1.50. You're going to have a stop, which is 50 cents. You're going to have, for example, in futures, a stop that, for example, has 20 points in the Dow, or has 7 points in NASDAQ. So they're all different. Fear comes from the lack of knowledge, and it's true. If you fear trading, and there's one more thing that I might add here. If you fear in trading, or when you're in a trade and when you go like, oh my gosh, I'm afraid, I just want to get out. You have that really hot potato feeling in your hand. That is basically, you can't take the heat of being in the trade. There are two things that are happening here. Number one, you're oversized. And when you're oversized, you're trading your P&L is the worst thing that you can do. You have to trade your chart. Do not look at the P&L when you're trading. Look at the chart. Leave the P&L aside and, toggle your chart. So I trade with Thinkorswim. So I basically pull my stops up, and I literally don't even look at my P&L for sure. And then I trail out until I trail out completely. And the other thing is that fear comes from lack of knowledge, is because you're not well educated. Because if you know what a setup is, if you know risk management, if you know strategies, if you know technical analysis, then you're not going to even mention, oh, but I don't have patience. This is so ridiculous when you think about it. So like, I don't have patience. You don't have patience for what? You don't have patience because you have no freaking idea what you were doing in the market. That's why you don't have patience. I mean, I'm sorry to say it like this, but it's what it is, what's true. Because if you had the market knowledge, you would wait for a setup to form before you took that trade. Taking a trade on impulse means recklessness. And an uneducated trader is always going to do that. So stay away from that. All right. Number two, you need to define your strategy. There is no strategy. There's not a strategy without education. So focus on the strategy and charts and not like on the P&L. Like I said, when you're trading the charts, you're trading continuation patterns, you're trading rejection patterns, you're trading trends, or against the trend. I'm open to both. We all do it all the time in the trading room. We do shorts, we do longs, we go against the trend, we go with the trend. The majority of trades are with the trend. Very few trades that we have against the trend. For example, if we had a massive pullback in the overnight trading session, and let's say the your trading session opens in the futures market, and then we can see that the market is trading right on support, then yes, I'm going to be looking for a trade, for a counter trend trade, right? That will take the price, wherever it goes a little bit higher. Okay. It's very important to not trade your P&L, guys. Once you learn how to do that, you're going to see that your trading will improve dramatically. Again, no egos, no crying and trading. Okay, it's time to kill your ego. Trust me when I tell you this. I have hit a rough patch when I first started day trading. I was day trading stocks, and I remember I was about 3 months into my day trading career. I was making good money, and trust me, I was trading very small size. My risk per trade was $100, and I'm not kidding you guys. I had a larger account size. I could have traded, for example, $5,000, per trade, but I didn't. So I started small. It's very important to start small, because it's one thing to trade with money and another thing to trade in a simulated account. If you want to test the waters, you could trade stocks, you could trade it with 2 shares or 3 shares, depending on, just choose a very small position size. Or if you want to do futures, you have the micros alternative, where you can literally test your strategies, test your, market knowledge and all that stuff. But I will talk to you a little bit about my rough patch. So everything was moving smoothly. So what happens when you're comfortable and you go like, I think I can do more, I'm ready to up my size? Well, this is exactly what I did. I upped my size from 100, I doubled it to $200 because I was feeling comfortable. But guess what I did? I have changed my strategy, because I thought, you know what, that's a stale strategy. I'm using it. I think I can improve it. So here's what I did. I signed up. That's like really many, many years ago. I signed up for a, it wasn't even a trading room. It was like a signal thing. Where we were in some kind of a chat room. It was a hot com room. It's very old. Like I said, this is like probably about 17 to 18 years old story that I'm telling you guys. And we would get alerts when there would be some kind of news in the market, and this news was communicated before hitting the wire. So before it was on CNBC, before it was anywhere else. Okay, so this was a really exquisite service that I had to pay an arm and a leg. I think it was like $600 or $700, and that is like literally almost 18 years ago. So it was very expensive. What do you think I did? So I was trying to get that news, capture that news, find the setup. So I was going back to my roots. So I had very good intentions. I did use my position sizing because I knew that I need to use that, because my mentor would have killed me if I hadn't. And guess what happened? I had loss after loss after loss after loss after loss. Why? Because I was trading news, guys. That's where news, that's what news is doing to your account. You can't trade just news, or, you can't incorporate news into your strategy. I like to trade the effects of the news. So for example, at 10 o'clock, we have a lot of data that is coming in, right? I like to trade the effects. So I let the market data come out, and then I can take a trade if a setup is there, okay? And there's no crying in trading. Well, yeah, because I remembered that, and listen, I quit my job to do this. So I didn't have a safety net. So I was using my savings account to trade. So guess what? Into about 6 months when I started trading, I would wake up every morning literally in tears. I would wake up and think about, oh my gosh, I gotta trade again. That brought tears to my eyes, because I was doing it all wrong. And it took me a while to realize that I have to ditch that system. So here's the thing. I would make it big on 1 or 2 trades, and then I will lose it all in probably 7 or 10 small trades. So it didn't really have a good win ratio. The strategy that news trading strategy didn't have a good win ratio. And I had students from the get-go, like 2015 or 2016, that literally went through the same things. Same things. And I think as traders, we all want to test out and try to find a holy grail. It's a thing, So here's the thing. I had a student, and I worked with him. He was in the trading room. He was doing really well. And all of a sudden, like I haven't seen him for like 3 to 4 months. And then he came back in the room. It's like, hey, I missed you. Like, where were you? I mean, are you okay? And he said, oh my gosh, I have a story to share. So what he did is he bought into the indicator hype. So he was making money just like I did when I first started trading. And then he made money for about 3 to 4 months. And then he started to learn an indicator. And it took him about 2 months to learn how to use the specific indicator. And then it took him 2 to 3 months to lose all his money that he had gained in the first 3 months, applying simple strategies. okay? So it's not just me, it happens to everybody. And I'm pretty sure right here. Okay, so there is a guy right here, 33136. Yeah, story of my life. It happens. It happens to everybody. And trust me, you know, it took some time because I knew that there were some things that were really working, and I was making, like, with that $100 risk, I was making like $1,200, and I'm like, oh my God, the potential is there. I have to keep on doing it. I just have to find these trades. I got to be more careful. And then I would find, like, you know, those trades that were like, you know, killing me softly, like $100 loss, another $100 loss, another, and I was like, red dot, red dot, red dot, red dot. Oh, it was just torture. It was just torture. Anyways, emotional sweaty palms. Are you trading way over your risk level? Like I said, you know, when you're having the sweaty palms, your forehead is sweating, you're oversized. You're oversized. Think about this. This is the best electronic game, computer game. This is the best computer game. And think about the market as a computer game. Think about every time you get in, you have like a token. That token is your 1R, okay? And that 1R has to be like, has to have like a really comfortable size, because if it's too much, you're sweaty. If it's too small, you don't care, right? So you don't have to care. So if you have a 1R loss, that should not affect your end game, should not affect the bigger part of your trading or the bigger part of your account. You know what I mean? Like, and start small. I have clients that have probably $5 to $6 million in their account, but say, hey, you know what? I'm going to go really, really down to a size that is really comfortable for me, for my risk tolerance, because for day trading is different. Okay. Day trading is different. Okay. Have a well thought process strategy that you implement every single day. So create that routine. So what I mean here is that you need to have that buy setup or sell setup or breakout, and you don't have to use them, for example, on, you know, every, you don't have to use them, for example, like you don't have to go outside of those strategies, and you don't just use one strategy. For example, focus on buy setups. Don't even sell setup. Say, hey, you know what? I'm going to focus on the trend. I'm going to find uptrends. Okay. And I'm going to do this for a month. I don't care if the market is in downtrend. I'm not going to be day trading for a month. Okay. So do it one at a time, because you're not losing money. You're actually gaining knowledge. Find a market that is trending, for example, or a stock that is trading. I mentioned earlier, I don't know, Procter and Gamble. It is trading, it's strong. Try to find breakouts or setups within the trend and try to focus on those. See how you do with those. Do it in a simulated account and practice position sizing, and do that every single day. Routine is something that is going to keep you really in check, and have that, but basically that routine is your trading plan, right? All right, trading mindset. Your trading system should be a really well-greased machine. Your trading system should be that machine that is like perfectly running all the time. It is just smooth, and you know, you don't even hear it. Your mindset is your psychology, and has to be in sync with your money management, right? Because remember, we talked about the trading size. You need to have a really comfortable size in order to stay in the trade longer, to develop that tolerance. So when you're using a higher size, that would not affect you, because the way you trade with on 100,000, the way you trade, for example, with a let's say $1,000 account, is the same way you trade with $10 million account. Okay, it's the same strategy. You're using the same strategy. You're using the same system. So your mindset has to be in sync with your money management, how you manage your money, how you manage your risk, how you trail your position, and your method, which is your strategy to buy and sell. And that is your trading system in a nutshell, right? It's the system, right? Basically, it's your strategy, the core, the mechanics, and what's around it, the mindset with the money management. This go hand in hand. Your mindset is your ability to control it And your mind drives everything you do in life, and trading is no exception. And trust me when I tell you this, trading is 90% psychological and 10% method. Because if you become comfortable with your size, with your strategy, then everything is like riding a bike. Okay, sorry. Okay, attitude. Your attitude will determine whether or not you're profitable with your trading. Okay, think about this. Early in the morning, before the market opens, you get a phone call from a telemarketer or from something that is really annoying, okay? Or you go pick up your mail and you see a neighbor that I don't know, parked on your lawn, for example. You get really annoyed. What do you think that's gonna do for your trading? It's gonna mess it up. It's gonna really mess it up. If you have a fight with someone, if you have something that, I don't know, if there's a water pipe that is bursting in your house, or if there is something that is provoking a distress for you, that day is done, okay? That day is done. So it's very important to be, in peace, in that Zen moment when you trade. Just leave everything aside. For example, when I trade, I literally close the doors to my office. I don't want to hear anything. I don't want to see anything other than charts. That is it. And one other thing, what is very important is to know how to react to the market. It's knowing and not what the market does to you. So basically, I'm talking about losses here and the attitude that you may have when you're faced with a loss in the market. For example, you have a stop out. Is that devastating? Because if that's devastating, that's a quick fix. It means that you have used too much size. So next time you have to bring your size down. Okay. So what's important is not what basically the market does to you, but how you react to the market, what measures you take from the market. Number 5, patience. No patience, no money. It's super simple because you have to wait until there's a setup right there that is so juicy that you cannot stand the thought of not taking it. Here's what Jesse Livermore said. This is my favorite quotes from all times from trading. Here's what Jesse Livermore said. I just wait until there's money lying in the corner and all I have to do is go over and pick it up. I do nothing in the meantime. So he's not over trading. He's just waiting. In essence, by not wanting to trade, I have transformed myself into a master of patience. And by forcing myself to wait until there is a trade that appeared so compelling that I could not stand the thought of not taking it, I have vastly improved my odds. I highly recommend this book, Reminiscence of a Stock Operator. Please read it. It's a really quick lecture. I like to read it. I take it to the beach with me, at least once a year and read it. I love it. It gives me more confidence. You're going to absolutely love this book. All right, let's talk about patience here. Patience is one of the key qualities you need to have in order to be able to deal with different situations in trading. From the point you decide to enter the trade, how you manage the trade, and wait for the target. Just sit, watch, and wait. That's all you need to do. That's our job. Our job is to wait. It's basically 90% waiting. There's that 90% mindset. It's 90% waiting. And then only 10% execution. That's it. So for example, you can see here that, the market opened and you can see how, choppy it was, like up and down, up and down, up and down. So once it broke above the range right here, it had the biggest candle. Why? Because buyers stepped in. Buyers stepped in and pushed the price higher. So wait, don't trade this chop, okay? Because you want to take it long. Oh my gosh, you go like, no, it's going to go down. I'm going to stop out. And you ultimately stop out. Just wait for the perfect timing. Wait for the perfect setup. in order to take the trades. And we're going to talk more about these tomorrow. All right, confidence. Self-confidence is the measure of your belief in yourself and has a number of consequences in trading. You should lack it. Essentially, being successful requires you to trust and follow your trading plan. Because the trading, you can go inside your trading plan, especially in your strategy side, and always make improvements and say, hey, I'm going to stock for a trade that is into an uptrend, for example, if the uptrend or a downtrend, depending on where the market is. So I'm going to look for a trade that is into an uptrend, and I'm going to look for a pullback, because you cannot get it on the fly. You cannot get it as running higher, bar by bar by bar higher. So you're going to have to wait for a pullback, right? And I want this pullback to be into, for example, into a 25% retracement or 50% retracement, whatever you have on your technical chart, right? And I want to have it into the 20 SMA, and I'm going to look for a buy setup that is forming off the 20 SMA, and I'm going to look for a target into the prior high. That's simple. It should be that simple. Confident traders rely on their own judgment and not what others are saying. So take full responsibility for your trading decisions, and you're going to fast track to profitability in no time. Let's talk about emotions, right? Emotions are probably the single biggest problems we face when trading, along with the lack of discipline. You can limit the emotional impulse of trading by having a trading plan. Again, who knew, right? So having a trading plan, not only that it's going to help your trading and improve your trading strategy and your profitability, but it's going to improve upon emotions. And it takes the impulsivity out of trading. It feels like, for example, like I have that, right? When the price action is going boom, 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 higher, you go like, oh my God, fear of missing out, right? But have the patience to literally wait until that's over, because I don't care if I miss a trade from a breakout or from a buy, and the trade just moves higher like crazy, goes, I don't know, 1% up or God knows what. I'm not interested. And I said, I don't care what this trade is going, okay? But most likely I'm going to look at the chart, I'm going to still monitor it and say, hey, you know what? This is a rejection zone. So this is a resistance zone. So as from this point, it can pull back. So here you have two options, right? What are the options based upon the strategy, based upon your trading plan? If it's into heavy resistance and it's going parabolic, if it's going climactic into resistance, what are you going to do? Short it, right? That's the normal thing to do. And then when it pulls back to a certain area that, let's say you have it in your trading plan, we talked about that 20 SMA, and it's doing a buy set up off of that 20 SMA, then you go long. Okay, so there are different things that you can play into this market that you need to have in your trading plan. It makes your trading so much easier because you're basically following a plan. So you can have your brain elsewhere, but you basically trade it. All right, so emotional swings and emotional stress do impact your mental state. It can ultimately affect your trading decisions. So when you trade with emotions, you do not trade logically. I gave you the example with the neighbor, okay? So the moral of the story, don't get your mail in the early in the morning or before trading. Trading involves the most emotional commodity in the world, which is money. Nobody is going to step away and say, hey, I don't have any emotions, right? I don't have any emotions. Well, of course I have emotions, because when the price action, and especially when the price is going my way, I become super happy, because when I stop out, I don't have emotions, because I'm only risking that one token, that one R. Okay, so that doesn't affect me. But when it runs higher, when I see it like, oh my gosh, you know, I have a whole run, it's going like 3 hours, 4 hours, 5 hours, or what? So we had an epic trade in gold, for example. We picked it up at 1831 and we rode it to 2000. So that was an epic trade. So that is when you have, you know, those joyful emotions and you go like, oh my gosh, how am I going to trail it now? That's your only thing, the only thing that you should care about. Money outlasts hate, love, greed, and anything else that you could ever imagine. Taking decisions. Trading successfully is all about taking and making decisions, although because of money and naturalistics, many people cannot remove their emotions from their decision-making process sufficiently. Decisions in trading and in life are basically about planning and weighing about risk to reward and risk and reward. So what are the most important elements of the trade? Can anybody tell me right here? The ESTRP. Okay, so basically it's the entry, the stop, the target, the trailing, and position sizing. These are the most important things. Expectation is one of the first problems that many traders face, and that of an unrealistic expectation. And what makes traders think that they can start trading one day and be super profitable the next day? That is unrealistic. So have realistic expectations when it comes to trading, set goals and targets. That's very important. Expectations will be met only by doing your homework. Holy grail. Oh my gosh. Holy grail, guys. Once trader realize that they may be some work involved, you know what? They don't like it. And they're always in search of the holy grail. Why do you think indicators are so successful? And they're making billions of dollars off of indicators. Almost every company out there, trading company, has an indicator. Oh, let me tell you my favorite indicator. They're all indicators left and right, because they're making money for the people that are selling them. The reality of trading is that there is no such thing as a perfect system. There's no such thing. You're always going to have losses. Do you guys know that algorithms, high frequency trading computers on Wall Street, owned by Goldman Sachs, Bank of America, yada, 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 they have way more stops than winning trades, but the end result is so much better because their win ratio is higher, okay, than the other way around. All right, fear. Fear is a distressing negative sensation induced by a perceived threat. What is the threat? I'm going to lose my money, right? It is a basic survival mechanism occurring in response to a specific stimulus, such as the pain or a threat of danger of blowing up the account. Okay, so is fear holding you back? Ask yourself, is fear holding me back? Fear of what? Fear of failure? Fear of losing your money? What is your fear? Because if you're fearing of losing your money, then it's time to get back to the drawing board, learn how to trade, and then you are going to look at trades much differently. There are tons of fears, okay? Fear of future regret, fear of being wrong, fear of being criticized, fear of personal failure, all right? Suggestions. Have a trading plan. Oh my gosh, I can treat my fear with a trading plan. This is like a Tylenol. It's good for arthritis. It's good for tooth pain. It's good for fever. Okay. So it's a trading plan. Is the trading plan. Trading plan. Respect your trading plan. Okay. Plan your trade and wait for the setup to happen. Put your plan in motion only based on your predetermined conditions. What if I told you that there is a method out there where you can self-coach and improve? Yep, that's journaling, guys. That's journaling, self-coaching. The trading day starts before the market opens and ends before the market closes. Shocked? No. You got to put in the work. If you want to do it on your own, you got to put in the work. Make sure you're aware of the market conditions before you start trading. Decide what you trade, decide parameters, etc. Have your game plan ready, and then just wait for the chart. What do you need to do? Guys, what do you need to do? Print 2 charts. On chart number one, trace where your entry was, trace where your stop was, and trace where you exited the trade. Chart number 2. Also, look at the trade where you have entered, where you have put your stop, where you needed to enter, where you needed to put your stop, and where you really needed to trail, okay, based on your trading plan. Journals increase trading consistency, detects errors, and in your previous trades, show where your mistakes were. Journals keep you accountable. Journals keep you improve your trading techniques. Here's an example. It doesn't have to be sophisticated. Just have the date, the instrument that you're trading, the direction, the entry, the stop, the target 1, target 2, target 3, exit price, gain loss, and details. right here, where you took it. The timing is very important if you're at the beginner stage of your career, if you're day trading. Make sure you put in updates. All right, so we're at the end of the presentation, but more to come tomorrow. We're actually teaching a class that's going to be in June. It's going to be all about power income. Do you want power income? That is something that I signed up for when I quit my job a long time ago. And I realized it not long after I had been educated how to do that. And it's my pleasure to teach you how it's done. This may be not for everybody because you may be at different stages, but this is a course for everyone. We have traders, really advanced traders that took the course that took them really into the stratosphere. So we teach you everything from A to Z. The course comes with, and basically with technical analysis, with strategies, with trading. We provide you the trading plan because I'm a true believer that, look, a lot of mentors are out there saying that, hey, trading is so personal. You have to create your own trading plan. Oh yeah, really? Why don't you give me yours if you're so successful, right? I provide you guys with my own trading plan. So included with the course, you get the on-demand recording, you get the live course, obviously, which is with me, 5-day course. You get the on-demand recording, you get an e-manual of close to 600 pages. You get members only lectures, group mentoring sessions, you get platform layout, limited live retakes. You come every single month to take the retake, support throughout the learning process, risk charts, and etc. If you want to go online, you're going to see that you only have a 1 month included with the sign up. However, for today and tomorrow, I'm offering you guys 3 months bonus trading month in the trading room to trade with me. This is basically where you take the course and now you make the money for the course. It's one trade that can make your whole entire course, seriously. And you have 1 personal mentoring session with me. This is huge. It's a 90-minute mentoring session with me. If you're interested in the course, you could go to TradeOutLoud.com/futures. We have been voted best in the industry by Benzinga last year for the best financial literacy tool for best trading education and service provided. This is everything that you get with the course. You get lifetime access to the power course, lifetime. We never cut it for you. You get manual, like I said, it's 600, not 400. You get unlimited live retakes. Every time we do a class, you're invited, and you are not invited. You have to come to the retake. You have to, because it's so much material that we cover. You're probably going to retain 25, so you have to keep on coming for more, and they're always free. 3 months access to the futures trading room. You get access to the 1-day trading lab. This is a bonus just for today and tomorrow for those guys that are interested in signing up. 1 private mentoring session, a private Twitter feed. We provide you with a platform layout so you don't have to reinvent the wheel. There's no chart toggling when you're trading. You just focus on charts. You have a Discord room just for students, student personal support. You have access to me unlimited any time of the day or week, and you get the risk sheet. Total value of the package is literally, if I have to sell it 1 by 1, which we do on our website, it would be $23,390, and we sell it for $5,999. If you think about this, you could become a pro trader, trade with me for $16.43 a day for 365 days. That's how much it costs. How many times you spend 20 bucks, like not even knowing, what you spend it on. So if you want to sign up, TradeOutLoud.com/futures. And if you have any questions, feel free to email me at info@TradeOutLoud.com. Don't really have a lot of time, but tomorrow I promise I'm going to dedicate more time to answering questions. All right.